Speakers for you today. Dr. Carrie Litkowski, Dr. John Newton, and Dr. Alan Featherstone. Dr. Litkowski is currently the team leader for the USDA Economic Research Service's Farm Income Team. Prior to joining ERS in 2017, she worked at the Bureau of Economic Analysis for 22 years, where she was responsible for the production of farm income and employment statistics for the nation's states and counties. Dr. John Newton is the chief economist for the American Farm Bureau Federation, the largest organization of independent farmers in the United States. In this role, Dr. Newton is responsible for the management of Farm Bureau's economics department and coordinates and conducts analyses used for the development of and the advocacy for Farm Bureau policy. Prior to joining Farm Bureau, Dr. Newton worked for the United States Department of Agriculture as an agricultural economist and was detailed to both the Senate Ag Committee and the USDA Office of the Chief Economist. Dr. Alan Featherstone is a professor in the Agricultural Economics Department of Kansas State University, an alumni of Purdue University and the University of Wisconsin River Falls. He was appointed at Kansas State in 1986 as lead agricultural finance scholar. He has studied land markets, investment decisions, mergers in the financial services industry, the probability of agricultural loan default and loan loss severity, the influence of taxes on farmland, and alternative federal tax systems. So we welcome all three speakers, and before we proceed, I'd just like to remind you of the method of submitting questions. You can submit questions at any time during our presentations, and the first presenter will be Dr. Litkowski. Great.
Great. Well, thank you so much for having me here today. I will have to confess I am not a PhD. I'm not Dr. Litkowski, how nice that might sound, but I do have nearly 25 years experience in measuring farm sector income. And I'm pleased to be able to have this opportunity today to discuss with you the latest USDA data on farm sector income and wealth. The goal of the program is to measure, forecast, and explain indicators of economic performance for the U.S. farm sector as a whole. We release our forecasts 3 times a year, and our last release was just on August 30th. And with that release, we updated our 2019 forecasts to include some new and updated data that has become available since our last release in March. That includes some survey-based data on 2019 crop planning, production, and prices, and the latest price and production forecasts from the August World Agricultural and Supply Demand Estimates Report, the WASDE report. So let's get right into this. We have 2 primary measures of farm sector income. First is net cash farm income, which includes cash receipts, cash farm-related income, government payments from farm programs, less cash expenses. We also have net farm income, which is a broader measure that incorporates non-cash items and non-cash expenses. It accounts for things like changes in inventories and non-cash economic depreciation or capital consumption. Now this chart's in inflation-adjusted dollars, starting with net cash farm income, as shown on the orange line. That is forecast to increase 5.4% in 2019, which would put it above its average from 2000 to 2018. Net farm income is also forecast to increase, but 3% from 2018. That would put it pretty close or just slightly below its average across 2000 through 2018. We derive our estimates of net cash and net farm income by measuring its component parts, and this allows us to deconstruct the changes or to identify what is causing this expected growth in net farm income. So on this chart, we have on the far left net farm income for 2018, and on the far right, the net farm income forecast for 2019. we go from left to right, we see we're forecasting a decrease in crop cash receipts of about $3.3 billion. This is largely coming from an expected decrease in soybean cash receipts. We're also making an adjustment for sales from crop inventories, and this is going to pull down income another $3.8 billion. Now, this adjustment is because we're trying to measure income from current production only, and so we try to remove any sales that actually occurred from inventories in the calendar year. Livestock receipts are forecast to increase almost $1 billion, and then we have a downward inventory adjustment for livestock inventory, leaving livestock production largely unchanged from 2018. Production expenses are forecast to increase $1.5 billion. Now that increase means lower income for the farm because we subtract out expenses in the calculation of net farm income. So what we're left then with is most of the increase is coming from an increase in government payments from farm programs to farmers directly of about $5.8 billion and a $6.4 billion increase in farm-related income. Now that primarily represents increase in payments from from insurance, commodity insurance indemnities, which I'll go right immediately to the next slide. This chart looks at net federal insurance indemnities and government payments relative to the rest of net farm income for the sector as a whole. And overall, we are forecasting that this increase in insurance indemnities and direct government payments are expected to cause the increase or boost the increase in farm income in 2019. The top bar on this chart are federal commodity insurance indemnities less premiums paid by the farmer. These are forecast to increase about $4 billion in 2019. This would be the highest level of net insurance indemnities since 2013. And the reason for this high forecast is we're expecting payments for prevented plantings to be higher in 2018 due to the Midwest flooding that we had earlier in the year. The orange middle bar represents federal direct government payments to farmers from farm programs. Now, this is expected to reach its highest level in 2019 since 2005. And the primary reason for this growth in 2019 in particular are higher payments for the Market Facilitation Program, the MFP program. Now, I think it's important to clarify how ERS is recording these payments to farmers. We record all of our payments to farmers in the year in which they were received by the farmer. So our estimate for 2018 government payment includes MFP payments that were paid out in calendar year 18 under the 2018 MFP program. And then our 2019 forecast includes the 2018 MFP payments that were actually received by farmers in the first part of calendar year 2019. The 2019 forecast also includes the expected payments from the first tranche of the MFP program announced in 2019. So in total, you can't really see it on the chart, we have about $5.1 billion in MFP payments in 2018, and we're forecasting $10.7 billion in MFP payments, the first tranche only, in 2019. Combined, these net insurance indemnities and government payments are expected to account for almost 30% of net farm income in 2019. And if you were to exclude these payments, you would have net farm income declining in 2019. This chart looks at production expenses or the costs that are incurred by farmers in order to produce their output. And they're forecast to be relatively stable in 2019. In nominal dollars, they're forecast to increase 0.4%, but down 1.3% when you adjust for inflation. Looking at inflation-adjusted expenses, what we see in 2019 is a fifth consecutive decline in government payments. We haven't seen a decline of this magnitude or duration since the farm crisis of the early 1980s. So what we're seeing, our farmers are reducing their spending as farm income or the receipts have generally gone down in the last few years. Moving on to the balance sheet, which provides us some information on the value of the physical and financial assets and level of debt in the sector as a whole. This is another way we can gauge the health of the farm sector. Historically, the balance sheet remains relatively strong. It's been somewhat stable in the last few years, but equity is forecast to be about 5% below its peak in 2014. Farm sector debt, the blue, is expected to continue to increase in 2019, reaching its highest level since 1982 when you look at inflation-adjusted dollars. On the asset side, again, the assets are forecast to be relatively unchanged in inflation-adjusted dollars, with the result being that farm equity is forecast to remain relatively stable. Now, another way to look at the exact same data is by looking at debt and assets, or debt relative to assets and relative to equity. Because what this reveals is that farm sector debt has been growing at a faster rate than the sector's assets. It's illustrated by this chart, which looks at the ratios relative to each other. We can get a measure of the solvency, or the sector's ability to repay financial liabilities or debt. Both ratios have been increasing since 2012 and are expected to continue to increase in 2019. And both ratios have remained above their average for the prior 10 years. So this indicates some growing financial stress, but still these debt to equity and debt to asset ratios are relatively low and suggest a low likelihood of default for the sector as a whole. One thing we can do with these sector level forecasts is try to project out regional trends, or how we might expect the farm sector forecast to affect regions differently. We do this based on what we know about how farm production, the commodity specialization and commodity production across the country is distributed. And we were able to use this using 2018 data from the Agricultural Resource Management Survey. So taking that, what we know about farms, and the distribution of farms, and these are just farm businesses, I need to clarify. So here we're talking about only those farms where the principal operator indicates that his primary occupation is farming, plus those farms that have gross cash farm income of over $250,000. So these are your larger, intermediate, or commercial farms. And here we see that we're expecting all regions to see an increase in average net cash farm income in 2019. We expect the largest increases for the Northern Crescent, and this is largely because we're forecasting out dairy cash receipts to increase in 2019, and that's where you have a lot of your dairy farms, the Northern Crescent. The lowest increases in average net cash farm income are forecast for the fruitful rims, like California and Florida. And these are reflecting the fact that we don't expect as big of an increase in vegetable and fruit cash receipts. I think they're actually forecast to remain relatively unchanged in 2019. Lastly, we've looked at income for the sector as a whole, but that often doesn't give a complete picture of how these households that are attached to farms are doing, because their income for the household is largely due to a combination of on-farm and off-farm income. Here we see that on the first section of this chart, that median farm income is forecast to increase slightly in 2019, but it's still expected to be negative, meaning at the median, farmers are not making money from the farm. Instead, in the middle section, we see that the money is coming from off-farm sources. This is things like off-farm jobs and non-farm businesses and transfer payments. And these are forecast to increase in 2019, which then leads to the forecast for median household income in total to increase. in 2019. So basically what we're talking about here is that net cash farm income and net farm income are both forecast to decline in 2018. I'm sorry, increase. Sorry, they're both forecast to increase in 2019. This is despite cash receipts from commodities and sales, which are forecast to decline in 2019. The increase then is largely coming from direct government payments and commodity insurance indemnities, both of which are forecast to increase in 2019. Total production expenses are forecast to increase $1.5 billion. Now this is all in nominal dollars, but it will decline in inflation-adjusted dollars. Farm sector assets, debt, and equity are all forecast to increase in nominal dollars, but remain relatively unchanged when adjusted for inflation, so they're not really keeping up with the rate of inflation. Average net cash farm income for all farm businesses is forecast to increase 11% in 2019, following the sector forecast for higher income. And median farm household income is forecast to increase almost 4% in 2019. With that, I encourage you to visit our website, but I will turn it over to our next presenter.
Great.
Great. Well, thank you, Carrie, and thank you, Karen, for the opportunity to join you all today to talk about the update on the farm economy. I think what a lot of what Carrie pointed out, the higher farm income in 2019, I think we need to take some of that and put it into perspective on where some of the on-the-ground conditions in the farm economy are today. And that's what I wanted to go through with those of you that have participated on the webinar. I'm John Newton. I'm the Chief Economist for American Farm Bureau Federation, also a board member for CFAIR. As Carrie pointed out, U.S. net farm income is projected to increase in 2019 to $88 billion. That would represent 3 consecutive years of higher net farm income. As Carrie also pointed out, a lot of the revisions to net farm income, when USDA did their first projection in March of 2019, they were projecting farm income at $69 billion. The reason we're now at $88 billion has to do with the second round of trade assistance package that was announced by the department this spring, as well as lower operating expenses. So the current forecast of $88 billion, we see federal supports up 42%, up $5.8 billion from last year. Again, that's the second trade package that's going out to farmers and ranchers this year. But when you take the federal support off the table, keeping crop insurance in play, we're looking at net farm income in 2019, $69 billion. Farm-related income is down nearly 3% or nearly $2 billion from 2019. So while we're seeing these numbers move in the right direction, I think some of the real-time indicators that we watch here at Farm Bureau are showing a different story. We hope that ultimately these monies flow to farmers and their financial situations improve, but currently we're not seeing that yet in some of the real-time data. One of the things that's really led to the downturn in the farm economy this year is the dramatic slowdown in farm exports around the world. U.S. agricultural exports through the first 7 months of 2019 are down $4.3 billion, down 5%. So sales through the first 7 months of the year are about $78.5 billion. The large decline that we're seeing in exports, primarily due to China. Obviously, China stepped out of many of the farm products that we sell. They're no longer purchasing the same volume. We've shipped, I think, anywhere between $6 and $7 billion worth of products to China at this point in the year, and normally we're closer to 14 or 15. So a very, very big decline in sales to China. We're also seeing some of our other Asian partners like Japan and South Korea, sales there are also falling dramatically. Sales to Japan down nearly $350 million. One of the reasons why we're seeing lower sales to Japan is the CPTPP trade agreement has gone into force, allowing other trading partners with Japan preferential access, which we do not have at this point in time. The administration has announced kind of a memorandum of understanding with Japan to open up that market more fairly to U.S. producers, and we hope to see that soon. But around the world, many of our largest trading partners are buying less and less agricultural products. That's why in 2018 and 19, we saw trade assistance dollars going out to farmers. The first round of trade assistance went out in 2018, about 8.5 to 8.6 billion dollars. A lot of that was monies that went to soybean producers. So you can see a lot of the payments went to Illinois and Iowa, to soybean producing states. In 2019, following a second year of China not being in the agricultural market, we announced a second round of trade assistance payments. Those were announced at a county level, and they ranged from $15 to $150 per acre. So it's the trade assistance payments in 2019 that's really leading to the expectation of higher farm income this year, as well as the higher crop insurance indemnities that Carrie mentioned that are related to the historic delays in plantings and record flooding across much of the Midwest. So it's those two tranches of money that are leading to higher farm income. The issue becomes farmers haven't received any of this money just yet, and then they haven't harvested the crops this year yet that they're going to sell that represents some of that net farm income money. So when you look at some of the real-time indicators, it tells a much different story on the stress in farm country. So here's 2019. I ranked net farm income from highest to lowest in inflation-adjusted dollars. So with the federal crop insurance support, as well as the trade assistance payments, we're right in the top 30% all-time in net farm income. That's where we are today. But when you take the trade assistance off the table, when you take crop insurance indemnities and other federal support off the table, we're sitting at around $69 billion. And that's in the bottom 50% all-time in inflation-adjusted dollars. So it's because of this support that the farm income is doing better than many expected. But again, the real-time indicators aren't showing that story just yet because farmers have yet to receive those monies. We're looking at a debt-to-equity and a debt-to-asset ratio that's climbed for 7 consecutive years, debt-to-asset at 13.5%, debt-to-equity at nearly 16%. Again, these are far below historical averages, but they're moving in the wrong direction. If we look at the percent of farm loans across the country that are 30 to 90 days past due, these are loans that farmers just can't make. They don't have the cash flow to make these payments, so they've fallen behind. We're looking at $4 billion in farm loans held by commercial lenders that farmers are not current on. In each state here, we're looking at some states that have a non-current rate well above the national average of about 2%. So the delinquency rate is also moving in the wrong direction. It's the highest that we've seen since 2012 on farm loans in the commercial sector that are 30 to 90 days or more past due. So again, that reflects the inability, the lack of cash flow that farmers currently have to meet their immediate financial needs. One of the other things that we've seen this past year is farm bankruptcies have accelerated. Farm bankruptcies in the last 12 months are up 13%. We're looking at the Midwest was up 12%, 240 bankruptcy filings there. I think Wisconsin led the nation with nearly 50 bankruptcy filings over the last 12 months. I think reflecting some of the challenges in the dairy industry. So the real-time financial indicators, we just don't have these monies from the trade assistance packages, and the crops are yet to be harvested that would indicate and lead to a reversal in some of these real-time indicators. So we're continuing to monitor the situation. I think many of our members are thankful for the trade assistance dollars that are going out. It does help them meet their immediate financial needs. But we also look forward to a resolution on these trade agreements. I think the concerning thing that our folks are thinking about, Farm Bureau members, is what happens in the spring of 2020 when we go to put a crop in the ground, when we go to meet with our agricultural lenders. If we don't have trade agreements done if we don't have USMCA across the finish line, if we don't have something done with China and Japan, it's going to be a much tougher year in 2020 if we don't see another third round of trade assistance dollars. Our folks don't want it. We want trade and not aid. But again, I think both this presentation and Kerry's presentation really highlight that without the trade assistance that we've received the last 2 years, we'd be in a much, much tougher financial situation in agriculture. Kind of wrapping up before I turn over to Alan, a lot of the information that you're presented here today, we do put on our Farm Bureau website at fb.org/market intel. We're going to release something later this afternoon on the farm income outlook. So please visit that. It's an excellent resource for you, and reach out to us at Farm Bureau if you have any questions. So with that, I'll turn it over to Alan.
Thank you, John. Great.
Can you send that link again, Karen? I think I missed it. Or is it showing my screen correctly?
It's showing your screen correctly, yeah. You're all set.
Okay. Thanks, Karen. Thanks, John. Thanks, Kerry. This is going to be probably a little different picture in terms of the information that we have is from Kansas and Illinois actual farm data. We both have a record system. We were able to track 586 Kansas farms from 2014 through 2018, and then 303 Illinois farms through 2014 to 2018. And probably the big thing is that it's important to remember that there's distributions around these numbers that both John and Kerry presented. And I think it's really important to understand just the broad distribution within the sector. In terms of what I've done is overlaid Illinois and Kansas net farm income from these farm record systems on the USDA numbers, which are in green on the right-hand axis. And then we have the net farm income per farm, orange for Illinois, purple for Kansas on the left axis. One of the things you'll see is that 2015 was the low year for both of these states. And then essentially with Illinois and Kansas, they both have increased. Kansas was more direct. Illinois was kind of up and down. But at the end of 2018, the net farm income was $103,000 for Kansas, and it was $178,000 for Illinois. To give you an indication, and I'll come back to these MFP payments, of that income in Kansas, roughly $37,000 per farm was MFP 1 payments for the crop side. And so if you would take the 103 and subtract off the 37, you'd be in the mid 60s for 2018. In Illinois, the average was probably 50 to 55,000. And so again, you can begin to see the magnitude of those payments. This next slide here basically just gives you an indication of what the average government payments per farm were from 2014 to 2018 in Kansas. You'll see that they were 28,000 in 2014, dropped to 20,000 in 2015, and the numbers, the accrual numbers in 2018 were 41,200. Again, that represents roughly 40% of the net farm income. If we look at the same numbers from Illinois, the government payments in 2018 were 46,000. That actually was a little bit less than the 52,000 in 2016, but quite a bit more than the 19,000 in 2017. And so in 2018, roughly 26% of net farm income was from government program payments. But with regards to this, these next 5 slides here are all set up the same, and I'll look through those. But essentially, this gives you the distribution of the numbers. The categories go from losing more than 250,000 in terms of in 2014, roughly 1% of the Kansas farms lost more than $250,000, 0 Illinois farms. But then if we look at making more than $250,000 on the other side, it is 18% and 16%. And so as I flip through this, it'll give you an indication. In 2014, which was a relatively good year, you'll see a lot of the distribution to the right. You flip 2015, that distribution moved substantially to the left. In 2016, Illinois moved substantially to the right. Kansas kind of moves a little bit to the right. 2017, Kansas improves a little bit more. Illinois drops back. And if you look at 2018, essentially both Kansas and Illinois were able to have a better net farm income picture. In terms of looking at these to give you the percentage of farms with net farm income, in terms of in 2014, there was roughly 11% of the farms in Illinois that were struggling with negative net farm income, and that bounced up and down, which is a different picture than Kansas, essentially 19%, then 40%, and then we've seen some improvement there, such that 1 in 5 farms, even in 2018, had negative net farm income. In Illinois, it was about 1 in 12 farms that had negative net farm income. And if you look at 50,000 as a family living, for those that don't have that off-farm income picture, just to give you an indication of the distribution below 50,000, and the argument, and you can argue whether 50,000 is the right number or not, but you'll see that there's just a number of farm families there that were not generating enough from the farm in order to meet their consumption needs. And so that certainly has affected the drawdown of liquidity, working capital, those types of aspects, as those that have that or need that farm income to live on basically have found a lot of difficulties doing that. Probably what's most important is that essentially not only is 1 year important, but essentially it's how many years in a row have they struggled. And essentially if you look at Kansas, roughly 2% of the farms have had negative net farm income each year from 14 to 18. And so those are farms that have struggled year after year after year. In Illinois, essentially about 2.5% of the farms. And so certainly those that continue to have low incomes year after year after year are certainly at risk either to need to make major adjustments with regards to their operation, or perhaps consider another livelihood. Conversely, and this is one of the things that is there, it's kind of a dichotomous type perspective. Through this period, roughly 1 in 3 farms has had a positive net farm income each year, and 58% of the farms, 57% of the farms in Illinois have had the same. And so, again, there is this dichotomous picture here where there are farms that are doing relatively okay, and some would say maybe better than okay, but there's also a subset of farms that are certainly at risk as we move forward. We look at the average probability to default. We rated each of these 300 farms in Illinois and 590 farms in Kansas. And you can end up seeing that 2016, 2017, 2018 have been relatively flat in Kansas at about a 1.8% probability of bankruptcy, in terms of 1.49, 155, 143 in Illinois. In terms of the debt to asset ratio picture, in Illinois, it's been relatively flat on these farms over the last 5 years. In Kansas, we've went from about 17 to 18% to about 22 to 23%. And so we have seen a little bit of creep. This next slide here, basically what we end up doing is we take the probability of default for each of these farms and multiply it by their debt, just to get an indication of the debt at risk for both Kansas and Illinois. We do that for a continuous sample, and then we do for all farms available. One of the things you will see is if you look at the average, generally from 2017 to 2018, we've actually improved while we've taken on more debt. Essentially, the probability of default has not increased as much, and actually we saw a little bit of an improvement there. And so essentially the debt at risk, while it is quite a bit more than it was in 2014, from 2017 to 2018, improved. The other thing to note is that there's a wide distribution with regards to these numbers. With regards to some of these farms in Illinois have 500,000 or more at risk. Some of the farms in Kansas have into the 400,000s at risk. And it's really important to realize that when you look at the distribution of these numbers, there's a relatively small number of farms that have more than 100,000 at risk. And so, but they do make up with regards to the majority of debt at risk. And so it's a very, again, skewed distribution there with regards to what's going on. The working capital picture, again, with the farm program payments, the MFP especially, from 2017 to 2018, both in Kansas and Illinois, we saw a little bit of a turn in the working capital position. We actually saw some improvement there, both for Kansas and Illinois, and in both of those states, that was a change in the picture from 2017 to 2018. Repayment capacity, again, you can look at those. Ideally, you'd have 100%. Basically, what that would give you is the fact that you have the income to pay all of your expenses and family living. And so ideally, that would be 100%. One of the things you'll see is that in 2014, we went from a relatively good picture. 2015 went down quite a bit. We have improved in Kansas very steadily, and in Illinois, it's been somewhat choppy with regards to as we move forward. In terms of thinking as we go forward, and I've done the same type of calculation for Kansas and Illinois, kind of using USDA's expected yield and the acres expected to be harvested. The 2018 numbers obviously are what's actually there. The 2019 are expected. And so when you begin moving that with the price, and essentially I just looked at the futures price for 2018 and 2019 to kind of give you an indication, but you multiply the price times the yield times the revenue. In 2018, the crop gross revenue for these four major crops, what is the bulk of the crop revenue, were $6.3 billion in Kansas. That's expected to be $6.8 billion in 2019. Illinois was about $14.6 billion. It's expected to drop to about $11.9 billion. And again, part of that is excess rain in a rain deficit state like Kansas is a good thing. Excess rain in a rain state that is usually pretty good. Excess rain is not good, and so you see a very different picture with regards to the crop revenue. And so while Kerry kind of has a drop overall, you can see that it is not going to be equivalent or equal across the country. The last thing that we've done, and this is Kansas only, but what we ended up doing is essentially we're able to look at the MFP payments from a crop perspective on each one of these farms to get an indication of just what the distribution is on those. MFP 1, which was announced in 2018, we're treating these all as accrual, and so while they cross the lines in terms of when you receive the cash, essentially we are treating them as accrual. And so MFP 1, the average payment for these Kansas farms was $37,500. Roughly 92% of Kansas farmers that we track receive those, an average of $41,000. 87% received more than $2,500. 50% received more than $25,000. There were 8% that received more than $100,000. If you look at the MFP2, we in the department, Nathan Hendricks and Joe Jansen did some work basically assuming roughly the same crop mix that they had previously, and then did this on a farm by farm basis using their 2018 information and assumed that it was generally going to be like this in 2019. Doing this analysis, the average MFP payment in Kansas is expected to be $58,000. 94% of farmers receive those, 92% more than 2,500, 68% more than 25,000, 16% more than 100,000. And so again, there is a distribution around that. In Kansas, there actually was more of an increase because they broadened the number of the crops that were able to receive payment. In Illinois, the change may not be as much. We're working with Nick Paulson to kind of get these numbers for Illinois on the 2 MFP rounds. To conclude, basically the income prospects are excellent for Kansas in 2019 with the MFP and with the other government programs and with the crop revenue. We're looking at probably seeing net farm income in the 125 to 130,000 range, which would be a 20 to 25% increase from what it was in 2018. Less so in Illinois. Certainly, there will be more crop insurance payments made in Illinois. And then you look at the decrease in gross crop income from Illinois with the 19% decline. I would suspect that Illinois will probably see a decrease in net farm income. Again, the farm sector is relatively strong in Illinois and Kansas, but there still are several farms that are at risk into the future. 2019 for a number of these farms, I think with the MFP, with the crop indemnity payments, I think it is going to be an opportunity to farms to position their operation for the future. If John is correct with regards to 2020 being a tougher year, I think a lot of producers are going to want to think through in terms of maybe paying some taxes and making sure they have working capital available. The alternative is there may be farmers looking at, with this increased cash income, are we going to invest in machinery in order to maybe reduce that income a little bit? And so that's going to be one of the things that's certainly going to be an issue in Kansas and maybe to some extent in Illinois, just seeing where those crop indemnity payments are. And so with that, I will turn it back to you, Karen.